Welcome to the Deep Dive. Today, we're digging into a recent earnings call. We've got the full transcript, the slides, all the analyst notes.
And our mission, as always, is to cut through the noise.
Exactly. To distill the key numbers, the management commentary, and really the forward-looking strategy that they laid out.
We want to give you that shortcut to being deeply informed on where this company is headed.
And for you, the experienced investor, the focus has to shift. It's got to go beyond just the immediate quarterly beat.
It really does. You have to look at the structural changes they're making. It seems like they're deliberately trading some short-term volatility for long-term predictability.
Okay, so let's jump right into that, because there's an apparent contradiction here that I think spooked some people at first.
Mm-hmm.
If you just look at the year so far, Q1, Q2, Q3 performance has been, undeniably strong.
Absolutely.
But then you look at the updated guidance for the full year, and it implies a pretty significant slowdown for Q4.
And that is the crucial point we need to unpack. Management was, very insistent that the business has to be looked at from a full year perspective.
Not quarter to quarter.
Right. Move away from that sequential comparison. But that knee-jerk reaction to the Q4 numbers was negative. And, on the surface, you can see why.
Of course. When you do the math, Q4 revenue, even at the absolute top end of their guidance, is set to be slightly down year over year.
Slightly down. And it gets worse.
The implied adjusted EBITDA for Q4 is expected to be slightly down or maybe narrowly up sequentially?
And definitely down year over year. So it just sounds like classic management spin, right?
Mm.
Lower the bar so you can beat it.
So how robust is their explanation for this? Because on its face, it doesn't look like a strategic success.
It's actually very robust because they're changing the entire philosophy of how they report and forecast. They're being purposefully conservative to reflect what they call true visibility.
True visibility.
So previously, they'd include pipeline potential in their commentary, the probabilities game.
Yep.
They've now shifted entirely. They're only talking about revenue that is already contracted.
Okay, so if they're only counting contracted revenue, what does that mean they're specifically leaving out?
They're leaving out any potential bluebirds.
Or birds.
Yeah, those unexpected, high-value, non-contracted deals that might land in Q4, but you can never, ever guarantee them.
So they're setting a baseline, a floor that they're extremely confident in.
Exactly. This isn't a business getting worse. It's the mathematical result of them succeeding at their goal, which is to migrate to a smoother, more predictable revenue model.
It's fascinating because that lumpiness we used to see and then the relief rallies when those periods ended, that's what they're trying to flatten out. They call it subscriptive momentum.
That's the term.
Let's dig into that strategic shift, because this migration seems to be the core of their whole thesis for the future.
Okay. So to understand the smoothing, you have to look at their two main revenue streams. They're actively moving away from those, periodic revenue drops.
The lumpy phasing.
Right, towards what they're calling level-loaded revenue.
And the key to that level loading, it seems, is in their audience businesses.
That's it, exactly. On one side, you have the audience businesses. You've got DAP, which is their data analytics platform, and EMUNT, which stands for Micro-Neighborhood Audience.
And these are the tech spine of their offerings, right? Highly data-driven, almost like software.
Very software-like. And because of that, they lend themselves to much earlier contract renewals.
Which creates that renewable visibility stretching out, into 2026?
Straight into 2026.
Yeah.
This is the part of the business that generates that predictable, continuous revenue. That's the subscriptive momentum they keep talking about.
And the other side of the coin.
Then you have the second stream, the execution functions. This is your classic point-of-care media and the omni-channel stuff.
So the HCP and DTC targeting, healthcare provider and direct-to-consumer.
Right. And those pieces, they're still largely transactional, they're performance-driven, and pharma companies usually budget for that stuff quarterly.
So just to connect the dots for everyone listening, the big growth they've seen has really been driven by DAP and ORNT.
Mm-hmm.
And because those are repeatable software-like contracts, it allows them to level load the revenue, which gets rid of that old lumpiness. So the whole Q4 softness question is just a function of this operational shift.
Precisely.
Oh.
They're sacrificing a potential pop in Q4 for a permanent uplift in predictability and, frankly, quality of revenue.
Okay, but does that predictability come at a cost? What about profitability? Let's turn to margins, because Q3 was surprisingly strong there.
It was a very pleasant surprise.
So what were the levers they pulled? Was it just a favorable product mix, or are they getting, better deals with their channel partners?
It was both, actually, but the mix was the key. They got a huge benefit from that favorable product mix. I mean, the strong growth in DAP and their DTC platform that we were just talking about.
And the partner leverage.
That too. As they scale, they're just getting better negotiating power with channel partners. It structurally improves their cost of revenue.
But there was a really important detail about their managed services revenue that we have to explain.
Yes, this is critical. Managed services is, hands down, their lowest margin product.
The lowest.
And management pointed out there was a lot less managed services revenue in Q3 than there was in Q2. That reduction directly contributed to the margin expansion we saw.
So why the reduction? Is it permanent? Are clients migrating to self-service platforms, or is this just a quarterly thing? Because that tells us if the margin expansion is real.
The commentary suggests it's structural. They are strategically de-emphasizing those low-margin, high-touch services where they're basically acting like an agency.
And pushing the tech.
Exactly.
Yeah.
Pushing the proprietary tech. As clients get more sophisticated, they use the DAP and M components more directly, so they need less of that low-margin hand-holding.
So the thesis holds. The margin expansion looks sticky.
It does. And looking forward, they seem really confident about it. They're stabilizing their margin guidance in the upper 50s to low 60s range.
That's a pretty strong floor.
And they're comfortable pointing to potential upside from there. So, okay, if the revenue model is smoothing out and the margins are stabilizing, what's driving the future growth?
Commercial execution.
It has to be. And specifically how they're handling the RFP, the request for proposal, environment.
And RFP season has apparently been very strong for them. Interest is split pretty evenly between HCP and DTC.
And they called out huge interest in their CTV ATD components. That's connected TV audience targeting and delivery.
Which makes sense. That's where all the ad money is heading.
But what's really fascinating is how their sales team is improving their win rates.
It's not just about responding to more RFPs.
No, not at all. They're engaging with clients so early and so intimately that they're actually helping to craft the RFPs to match their own solution set.
So they're avoiding that old spray and pray approach where you're just responding to everything.
Exactly. It's a sign of a really mature consultative sales process.
And that ties right into one of their biggest growth engines, doesn't it? The mid-tier opportunity.
Yes. We're talking about clients outside the top 20 or 30 big pharma manufacturers.
Why is that segment growing so fast for them?
Because those smaller firms, they often can't afford what they call the internal Cadillac support that the giants have.
So they're licensing this tech?
They're licensing DAP and EPS, and they're basically replacing capabilities they could never afford to build themselves. It lets them compete on a much more level playing field.
It's essentially democratizing the pharma marketing tech stack.
That's a great way to put it.
But wait, servicing smaller clients? That usually means higher churn, lower contract values. Does that risk diluting margins or just making the sales process more complex?
It's a fair question, and they are addressing it. The key for them is operational leverage. They point out that their operating expenses on a cash basis are remarkably stable.
It's a highly leverageable business model.
Extremely. The cash OPEX is only up about $2 million over the prior year.
Which is incredible given the top line growth.
It is. And they clarified that small increase is almost entirely driven by variable comp and bonuses that are tied to that top line outperformance.
So if you strip that out, the core operational cost is almost flat.
Almost perfectly stable. It shows superb operating leverage. They can scale the business without having to scale their fixed costs along with it.
Okay, let's talk about their long-term visibility. They seem unusually confident enough to give general bookends for 2026 guidance. You just don't see that in this industry.
That confidence comes from one place, the retention baseline. Historically, only about 5 to 15% of their business comes from new logos each year.
So the rest?
The rest, the huge majority, 85 to 95%, is from net revenue retention. Existing clients spending more. That's the bedrock for that 2026 guide.
And if we tie this back to profitability, the midpoint of that 2026 guidance implies something like 60 basis points of EBIT margin expansion.
And again, it's structural. It's not a one-time thing. It's driven by continued gross margin expansion, which is fueled by that high-margin DAP and MENT growth, plus optimizing their channel mix.
Okay, bigger picture. Macro trends. They still believe their whole solution set. especially that CTV ATD stuff.
will benefit disproportionately from any potential ban or even just a reduction in linear TV pharma advertising.
They're perfectly positioned to just catch all that ad budget as it shifts to digital.
But this is where it gets really interesting, and where I think the market might be missing a massive piece of optionality.
The Lamar advertising partnership.
Exactly.
So tell us about this pilot. It's focused on out-of-home advertising, right? Ooh.
Right. Lamar has this massive inventory of traditional billboards. Our company is brilliant at patient finding and precise targeting. The partnership is about transforming those physical billboards into precise digital screens using their tech.
So imagine a billboard that only shows an ad for a diabetes drug when it knows the target demographic is driving by.
That's the idea. And the size of this opportunity, according to management, is very large.
Okay, but here's the crucial part.
And this needs to be emphasized. Zero contributions from this Lamar partnership are factored into their 2026 guidance.
So it's pure, unadulterated potential upside.
Not priced in at all. It's essentially a free call option on the entire digitalization of out-of-home pharma advertising.
So this brings us to our final segment. What does this all mean for investors? And we need to be crystal clear here.
Absolutely.
What follows is for entertainment and speculative analysis only. It's based purely on the transcript's content. It should absolutely not be taken as financial advice.
Understood. But if we were going to build a thought experiment, an outrageous but plausible trade idea based on this Lamar optionality.
You'd be betting on a seismic shift in an entire industry.
A huge shift.
Yeah.
The core idea is that this patient-finding billboard transformation could be a monumental lever.
And since management confirmed it's a very large opportunity with a 0% contribution in the guide.
You have to construct a trade to capture that optionality.
So the speculative trade would be what? Shorting a traditional media asset, maybe a direct competitor in the OH space that's still all in on static, non-digital billboards?
And simultaneously going along the company we're discussing.
So you're betting everything on that patient-finding billboard tech working and scaling. The short leg hedges you against broader media spending slumps.
While the long leg gives you this highly leveraged position on the digitalization of pharma OH. An angle that is completely unfactored in their current estimates.
You're getting the digitalization story for free.
That's the trade. It's aggressive, but it captures the scale of the optionality.
Excellent. So wrapping this deep dive up, the main takeaways for you, the experienced investor, seem pretty clear. We're seeing a successful strategic shift to a smoother, higher visibility model.
And that conservative Q4 guidance is a function of that success, not a sign of weakness. It's setting them up for potential beats down the line.
And you cannot overlook the massive optionality from that Lamar partnership, plus the high-quality RFP wins they're getting now.
A commercial team that's getting ahead of the client's needs instead of just reacting.
So our final provocative thought for you to consider is this. How much of this company's future value is tied not just to the tech, but to their success in guiding the commercial teams of those mid-tier manufacturers? They're democratizing this incredibly sophisticated ad tech, letting smaller players compete. That ability to consult and guide the companies that can't afford that Cadillac support might be their true long-term market capture strategy.
A great point on the power of democratization. And of course, just remember that any forward-looking statements we've discussed today are subject to risks and uncertainties. Always do your own critical thinking.
Thank you for joining us for this in-depth analysis. We look forward to having you back for the next one.